Did last week's sell-off scare you? Let's get to the bottom of this and what you need to know right now. Here we are again. Last week, we did a Suze School on what? We did it on what Michael Burry did to the markets and how, in our opinion, because I agree with you, totally manipulated.
Oh my God, Michael Burry bets Palantir is going to crash. And sure enough, that's exactly what happened.
So here we are now. The week just ended, a horrific week for the stock market. Many people are absolutely freaking out. They actually, Keith, freaked out more this week than they did the week before when Palantir really went down and NVIDIA went down. Now, everything got hit. So now explain to everybody what's really going on and why. This is an opportunity of a lifetime if they could just understand that.
I would be delighted, because what makes this week different from last week, Susie, is last week the nonsense and the shenaniganry was largely confined to 2 or 3 stocks. It was NVIDIA and Palantir right at the top of the list, because that's what Mr. Burry, Predictimus Maximus, decided to file on, in addition to all of his other holdings. But what makes this week different is that when he did that, it was like throwing a rock in the pond. Suddenly you have ripples. And all of the pension funds, endowments, large funds, index funds, mutual funds, ETFs, they all picked up on that. And so this week what happened was that selling got the computers going. Now suddenly all of the computers have the incentive to begin selling and unwinding because they determine that there's the probability of a disturbance. The big institutions often invest because of flow. And what I mean by that is that if money's coming in, they buy. If money's going out, they sell. And so when Mr. Burry threw a rock in the water, he ignited a flow battle. A lot of funds said, I want out. A lot of funds said, I want in. And volatility shows up, and more sellers than buyers appeared at the table. And so we saw this big, massive sell-off because nobody wanted to be the last person at the party. And that's really, when you break it all the way down, as simple as it gets.
When somebody sells a stock, somebody has to buy that stock.
Bingo.
So therefore, who is buying what we are selling right now? And when I say we, it's usually everyday people. They've gotten scared. They are out. They already have a profit because really they have listened to us, Keith, and they bought Palantir. They bought NVIDIA. They bought all these stocks, and they're still up. It's not like they've lost money. It's just that they've lost profit. And so then what comes is that, oh, my God, I don't want to lose any more money. I'm getting out. That's it. I've had it. Is it what some people want them to do at this point? Who is buying what they are selling?
That is literally a $1 trillion question, because people tend to look at the headlines and all the red on the screen, Susan, and they think, oh my goodness, I better sell. Oh no, I can't be the last one at the party. Oh no, I got to turn out the lights. But the reality is you can't just sell into a vacuum, right? You can't play catch with somebody who isn't there. And what's happening is every individual who gets scared and sells, there's an institution or another investor buying their shares. So really the way to think about last week and why it's such an opportunity is that all of that selling meant that somebody else was buying, and they were buying a lot. So bottom line on that one is the deeper and steeper the sell-off, the more opportunity there is on the other side for investors who understand that for every seller there is a buyer, because that's the side of the equation you want to be on, is the buying, not the selling.
And so here you are, and you have a stock. You've made a lot of money on it, meaning, and the truth is, you don't make money, people, until you do sell. You have something known as a free trade. You buy a stock and it's doubled. Once it's doubled, once you're up 100% on your money, you usually say what, Keith?
I usually say sell half of it. And the reason I say sell half of it is, number one, if you do that, you pay for your original investment, And number two, now you are free to let at least that initial investment ride till the end of time for free with no worries about whether it goes to zero or whether it goes to $100 gazillion. The point is you now own it for free. It makes you the house in Vegas, not the patsy at the table.
And what's the hardest for people to do about that is that, and we'll take Palantir, for example, it went from 7, went to 14, went to 28, it kept doubling all the way up. And would you have suggested to those people to keep doing one free trade after another free trade?
Mm-hmm.
Or would it have been better for them to just keep it and have all of those shares, and now they would have really made a whole lot of money? Because I think what's hard for people to get is, oh my God, I sold half. All right, now I'm playing with the house money. But if I had just kept it all in there, this is how much money I would have. What would you say to them?
I would say the same thing I say every time. That's your greed gland working overtime. And you need to get that out of the equation. Keep your emotions off the table. And the reason is that studies, my research and others, show that when you use a tactic like this, and you are periodically selling into strength, and then when it drops, buying more and selling into strength and buying more, you're actually more tax efficient in many cases, but more importantly, you wind up with more shares than you would have otherwise if you just stayed true to it from the very beginning. Now, dividends can change that a little bit over time, but with a company like Palantir that doesn't pay any, what it shows is that volatility you fear is actually an advantage. Somebody's opening the door every time there's a pullback for you to accumulate more shares.
So what I'm trying to say to all of you that are listening right now is that when it comes to investing, I want all of you to stop looking at, look what my portfolio is up today. Oh my God, I'm up X% on this. Look at this. Oh my God. And you get so involved in how much money you've made. But again, you don't make it till you sell, that you forget to look at your portfolio and go, do I have too much in one area? Am I too much just in AI? Because I obviously, Keith, as you know, have an extensive portfolio of far more than just artificial intelligence. And while those stocks were going down, my other stocks were going up. And the truth of the matter is my portfolio didn't lose money overall. What would you tell people to do as a perfect portfolio right now if you were going to instruct them?
Well, to borrow a term from your own experience and your legacy, you need to construct the must-have portfolio, right? Now, the must-have portfolio is not about the hot stocks, contrary to what people think. And I get asked this all over the world by folks who are investing. Hey, Keith, what's the next hot stock? Wrong question. The number one piece of advice to investors listening today is you need to forget about the hot stocks. What you need to focus on is the stocks that are going to be there in 10, 20, 30 years when you need them, when your family needs them, when your grandchildren, your unborn great-great-grandchildren need them, because the longevity is what really creates the value. Now, again, you're going to be buying and selling. It's going to be volatile, going back and forth all the way between here and then. But when you get right down to it, the list of companies that is really changing our world is actually very, very short. And you don't want to be playing with stocks that are just a better mousetrap. You want to be investing in stocks, and they can be utilities, they can be stores, they can be athletic manufacturing, whatever the company is. It doesn't have to be AI, because it can be another company that is changing the world in a way that is not yet picked up on the media or recognized by the headlines. So you've got to concentrate and you've got to play to win. Because the other mistake that people make just since time began is they fear losses more than they like winning. And what I mean by that is they would rather say, oh, I avoided that loss. But the problem is they worry about things that they can't control. If you flip that around, which is what I've encouraged investors to do for 45 years now, you play to win. Which companies are going to be there? Which companies are going to help me achieve my objectives and be there when I need them? And my objectives can be growth, they can be income, they can be exposure, they can be any number of things. But the important thing is I'm constantly maneuvering to win. I'm not worried about not losing, because I don't like to worry about things I can't control. I do like to worry about buying great stocks, at what price I can do it, what tactics do I use that can increase my future. And that's really the message.
And when you say your future, the truth of the matter is it's everybody's future.
Yes.
Because our job, the two of us, is to bring this information to everyday investors, moms, pops, kids, whatever, so that they, number one, get educated, they understand it, but they know what to do. One last thing, because I know we're coming close to an end here. When do people sell? When would you just say, I'm out, get out? Like, is there advice to keep people from freaking out and selling a good stock, and yet they keep their bad stock because their bad stock probably isn't doing anything? What advice would you give them at this point in time?
We have one golden rule, and it's something I learned from my mentors decades ago. There is only one rule that applies. If you buy a great company because it's great, and you can identify all the reasons that it's great, the question you want to ask yourself on a big down day is, okay, do all the reasons for which I bought this particular company still exist? And if the answer is yes, you grit your teeth, hold your breath, go for a walk, whatever it is, but you hold on because you know that the reasons you bought the company are still there. If a company does not any longer embody what it is you bought it for or the reasons for which you bought it, then boom, gone. Don't let the door hit you in the rear end on the way out. Don't ever look back. So for example, Apple has had its share of trials and tribulations in recent years. People have said, oh, innovation's dead. Tim Cook doesn't know what he's doing. They're not into AI. They're falling behind. None of those things is true, but that's what people think. So my argument with Apple is if Apple suddenly turned around and decided it was shifting 100% of its production capacity to making swimming pools, I'd be gone like a shot because that's outside their primary expertise. It's outside their primary vision. It does not align with the reasons for which I bought Apple originally and encourage investors to continue to buy Apple today. So, if we look at Peloton, for example, people flip that around and say, well, oh, this is this great innovative company. And I said, no, an iPad on a bike is not a functional business. Just ask the folks at GoPro, lost 98% of their money. And today, Peloton continues to struggle. So this is a question of I wouldn't even buy it in the first place because it doesn't fit the fundamental reasons for which I thought it might be a great company.
All right, that's a wrap. Keith, thank you so much. It was fun again, Fitzy. So everybody, don't forget to subscribe to my YouTube channel. Just click right there. Just go ahead and do it. And click on Keith's as well. Subscribe to both, and you'll be in the know. All right, everybody. See you soon. Bye-bye.